Introduction to SRP. SRP is the most comprehensive and trusted source of structured products data and market intelligence. With a global database of 45 million products, our data solutions uncover insights into market structure, sales volumes, key trends, and competitor activity. The choice of leading investment banks, hedge funds, product issuers and distributors, exchanges and asset managers, SRP provides everything you need to understand and stay ahead of the market, with regular updates, data-driven analysis, and access to our special reports covering the latest trends in the structured products industry. SRP data can be accessed from our product search and analysis portal or by integrating our API with your own infrastructure. Welcome to Connected Intelligence.
Hello, and welcome to another episode of the SRP webinar series. Thank you for joining us. I'm Pablo Conde, Director of Content at SRP, and I will be your introduction host for this webinar, which will be delivered in partnership with the Derivatives Academy. I have with me today Maxime de Belfoy, founder of the Derivatives Academy, and Cyril Henry, a structured product specialist, who will provide an overview of the different building blocks and moving parts involved in the manufacturing and management of structured products. We have a great learning session planned for you today. With an overall market size of over $2 trillion, the first half of 2024 has recorded increasing sales globally. If we look at tranche products, the ones with the blue bar, these are the products which have a maturity date. We can observe that Europe holds the largest proportion at 43%, followed by North America at 31%, and APAC at 25%. Over the last 5 years, North America has shown steady growth, while Europe experienced a decline initially, just before the COVID pandemic, but has fully recovered and is now on a growing path, especially from 2022 onwards, which coincided with the interest rate increases. In APAC, on its part, has seen an outstanding sales slowing down and fluctuating during this period. On the next slide, we can see how sales in APAC ex-China have fluctuated, but are expected to achieve moderate year-on-year growth of 14% in 2024. North American sales have also grown significantly after 2020 and are expected to accelerate in 2024 on the back of a 39% increase year-on-year recorded in the first half of 2024. Europe has also shown a strong recovery trend since 2021 and is expected to reach a projected year-on-year growth of 15% in 2024. On the next slide, looking at capital protection, we can observe that over the last 5 years, we have seen a recovery of capital protection, a recovery of capital at risk products at the expense of capital protection. Capital at risk products represented 80% of the market at their peak in 2021. That has been a trend that has been declining, and as a result of the shift in the product mix triggered by the higher rates environment, which was favoring capital protection. Since early 2024, capital protection has lost some momentum, with most markets turning back to products offering a higher return in exchange of some risk. As a result, capital at risk products have seen their market share increasing by 69% in H1 2024, as you can see on the right-hand side of the slide. Let's move to the next slide, please. On the payoff structure front, we have also seen different trends. Auto calls linked to equities remain the central product across markets and regions. And one of the things we've observed is that these products has had longer maturities, and there was also an increase in early redemption features in H1 2024. After 2022, the market saw a significant decrease of auto-callable products as there was a shift away from equity-linked capital at risk towards capital-protected structures. This is particularly visible in North America, where callable structures represented 25% of the offer during the first half of the year. In APAC and Europe, callable products have also increased their presence. And in the last slide, if we look at the breakdown exposure to equities by stocks and indices, there is a clear shift in demand for products linked to stocks and worst of stocks baskets in H1 2024. Issuance is clearly moving away from less concentrated indices to more targeted stock picking. Multi-stock baskets also show a very significant growth in APAC and Europe, whereas in North America, the preference remains for multi-index baskets. Another trend we've observed is that single stocks are the third most popular underlying type in North America and Europe, while the market share of single indices has shrunk across the three regions. And with this, we are going to move to the main presentation. Please talk us through the main characteristics and building blocks of structured products and how they are delivered to the public.
Thank you, Pablo, for the introduction. So let's get into the topic. On this presentation, we'll cover different topics. We'll start with the definition of a structured product and see basically how it's built and different components. We will then see the different stakeholders of the industry and move on to the advantages and disadvantages of this asset class. And finally, we will look at the different type of structured products and look at concrete examples to illustrate the presentation. At the end of the session, we'll end with a small Q&A if we have some time left. So moving on to the next slide, we will start with a definition of a structured product to understand what it is, regarding the key characteristic and different wrappers and composition. So moving on to the next slide. Okay, first, we need to know first that the structured product is a very flexible investment instrument. The redemption value is linked to the performance of underlying assets that can be stocks, currency, commodities, bonds, etc. Anything you want. Those products can be customized to match almost any investor needs regarding the market exposure they need, the maturity, the level of protection, etc. So there's not one type of structured product. There's many types. We'll look at the different types later. And most importantly, they are almost all unique. So how do you do that? Generally, a structured product is a combination of two components. There's the funding component, which is a bond or debt issued by a bank that can ensure a certain level of protection to the investor. And there's, on the other side, a performance component, generally done with option and swap. That will be used to generate coupon, performance, as well as generate more risks. So it's really the combination of those two components that will form a structured product. Moving on to the next slide, we can identify mainly two types of wrappers that are warrants and notes. So for regarding warrants, I will not enter into much detail. It's not the typical structured products. They are similar to option. They give you the rights to buy or sell a stock at a certain price. And the cost is low, but it can easily expire worthless. So if the strategy works, investor makes money. If the strategy doesn't work, product expire worthless, basically. No. Regarding the notes, generally speaking, when we talk about structured product, we talk about notes. So let's look at an example here of a typical structured notes. So it is, as explained in the slide before, composed of a funding component and a performance component. Performance component would be optioned, that we call here the risky asset. The funding component is always a zero coupon bond. It's bought at discount, for the example, let's say 80%. And at maturity, if the issuer of the bond does not default, it's a very important point, it pays back 100%. So it's usually seen as the non-risky part of the investment. There is no market risk on this part. But as you can understand, it's not very risk-free. On the other side, there is the performance component. It's composed of options that will be used to customize the product. This part will generate either more return or losses depending on the performance of a certain underlying asset. So moving on to the next slide, we can see a graph showing those different components. So here in the middle, you have the zero coupon bond that is bought at discount. That will pay at maturity 100% of the initial investment, if no default of the issuer. But today, it's worth less, let's say 80% for the example. So there is some money left to invest into options and pay fees. That's the other part. The initial strategy here this is just an example, but the initial strategy, the product is also composed of a long call, meaning that the investor is long a call option that will pay a positive value if the underlying asset perform well. So it's just an example. It could have been strike of coupon, for instance, the participation. And there is also a short put, meaning the investor sold a put. It's typically how buyers are created, that add potential losses to if the underlying perform bad. So it's more risk. It's not in favor of the investor, but adding a short position allows the structure here of the product to buy more long position. Okay, more risk always equal more reward. And finally, in the structure of the short product, there is fees. So as you can see here, the more the fee, the less the structurer have money to spend on the other assets. So this is typically how a structured product is built. There is a bond issued by a bank and option, adding potential reward and risk that depend on the performance of an underlying asset. Now on the next slide, Maxime will talk to you about the different stakeholders of the industry.
So yes, hi everyone. So regarding the stakeholders, we typically divide the stakeholders into, so the sell side is actually obviously selling and issuing the structured products, and the buy side, which as the name says, is buying the structured product. So on the sell side, I will now just speak about three types of people. So the sales, the structures, and the traders. So no offense to all the quants, risk managers, marketers, whatever. These are just the three main type of front office position I will speak today. So the sales position, like obviously as the name says, they're in charge of selling the structured products. So they are the first point of contact with the clients, and they will obviously their goal is to try to sell as many structured products as possible. So they will be more inclined to be aggressive, and they want the largest number of deals. They hold a very trusty relationship with their clients, and they also need to have a more technical background that you may think, because obviously they need to understand all these kind of different products. So that's very interesting job, I would say. So don't underestimate their job, I would say. The structures, they are the ones, so the sales, they can also give prices. I mean, they give prices, but they typically don't price the product. They do it most of the time now because everything is automatized. So there are a lot of standardized products that they can price. But normally pricing and structuring the product is the role of the structurer. The structure, they will be in contact with the traders as well, because obviously whenever a product has more risk, you need to give a price to this risk. So you will need to talk a lot with your trader to know, okay, how much risk do we have? Are you capable of hedging your risk? And how much would you like to be paid for holding this risk? So there is a close relationship between all these groups of people on the trading floor. So yeah, that's the role of the structure. The traders it will be also involved in pricing all this structure. So every time there is a sales of structure putting that is done, the structure is coming into the book of the trader, and he will need to hedge all the risk during the life of the products. So typically the sales is very involved initially before the trade. Then once the trade is done, the trader will have the product in his book and will have to hedge all this product during the entire life. So it's a very dynamic job. Every day they need to hedge everything because everything is very dynamic. So yeah, that's a very interesting job. And there is a balance of power between these three groups of people, because obviously the sales, they want to trade. They want to make a lot of transaction with the client. They want to be aggressive on their prices because they want their clients to be happy with the price they see. But the traders, they don't want to accept all the risk, at any cost. They will need to bear this risk during the product because that's a big of a difference. Because whenever a sales sell a structured product, he actually knows he's going to earn some money on this because he's earning some commission. But the traders is not. Every time he sells something and he got something in his book, he's not sure he's going to make money on this flow because that will depend on the hedging cost during the life of the product. So that will depend on what the market is doing during the life of the products. So that's not something that is that easy. So the traders will tend to be a bit more defensive and the sales more aggressive. And then in the middle, you have the structures who is trying to play a little bit the balance, I would say. So on the next slide, we'll discuss about the buy side. The buy side is typically divided between retail investor and institutional investors. So retail investor, they're asset management firms or private banking, family offices, and that kind of actors, I would say. The payoff are typically more simplified, and so it must be marketed accordingly as well. So things need to be a bit more well explained. You need to make sure that they understand properly the risk of the product. Structured product can be looked a bit like complex, so they need to be well explained. And it's typically more standardized. So typically you have a bit less of innovation on this one, and the favorite kind of products is the yield enhancement product. For institutional investors, so typically hedge funds, mutual funds, insurance companies, these are the institutional investors. So obviously they buy structured product for their business, I would say. So they are a lot more sophisticated and you have more room for innovation for that kind of clients and that kind of product. The solution that you create for them, it requires a bit more work. So it takes a bit more time, but the notional, so the size of the transaction are bigger. So if you go to the next slide, we'll discuss the main advantages of the structured product. So regarding the flexibility of structured products, so you can go to the next slide. Obviously, you can reproduce all market views because as Cyril said, they're very flexible. So you will often say, okay, you will often see this is a good market environment for structured product. There are no really bad market for structured product, and that's one of the big advantages. They can actually reproduce every single market view. If the rates are very high, well, good. You can take a bit more duration, more longer products. You can buy yourself more performance. You can buy yourself more upside. If the rates are low, eventually you're going to do shorter products. If volatility is high, maybe you're going to try to sell some volatility to buy yourself some performance. If volatility is low, you can try to buy some volatility. You can always do something. That's the beauty of this asset class. In terms of diversification, it's really a good product as well because you can get access to a lot of asset classes that might be not available to you otherwise. So you might get access to emerging market stocks, for example, very hard to trade. You might get access to some real estate on paper, some commodities, all of this kind of stuff are very hard to get access to or not easily if you trade small sizes. So yeah, that's a massive advantage as well. And in terms of diversification, because you can create whatever you want as a product, they might have a risk return profile that is very different to what you usually have when you buy something, which is a very linear, I would say, investment. So by changing the risk return profile, you're actually bringing some diversification inside your portfolio. Liquidity is another advantage because the issuer is actually assuring a secondary market. So all the time, whenever the market is open, you're capable of getting rid of your position. So you can increase or decrease your position at any time with a specific bid offer that is offered by the issuer. So that's something that is very appreciated as well compared to other asset classes, which might be less liquid. And the last advantages on the next slide is obviously, since it's very flexible, it can satisfy absolutely any risk profile. So if you're looking for more a speculative trade, for example, you might look at leverage products. If you're looking for some income, you might look at yield enhancement product. If you're more conservative, then you might be looking at capital protected product. So whatever your risk profile, you can always create a product that fits you, and that's a bit the beauty of this asset class as well. So now I think you can move to the next slide, where Cyril will speak about the risk and the disadvantages.
Yes, thank you, Maxime. So I will only talk about main risk here, as we don't have enough time to cover them all. The first and most important risk we may think of is the credit risk. For people who discover structured product for the first time, it's not the most obvious. But as we've seen before, the biggest part of the initial investment goes into a bond issued by the issuer of the structured product, the bank. So if the issuer defaults and do not repay the bond, the product could expire worthless. It's not a highly probable scenario, but it's a risk to consider. To reduce this risk, diversification is key, not only regarding the underlying, but also regarding issuer. You don't want to put all your eggs in one basket. To evaluate this risk, the rating of the issuer is very important. It goes generally, for most issuer, from AA. Maybe there is a few local bank rated AAA, but most issuer, the biggest, could be rated AA, from BBB minus. It's the scale approximately. Lastly, the issuer of the bank may differ from the distributor of the product. It can happen. You can be in contact with a bank A selling a product issued by a bank B. The issuer information is always available on the documentation. You will find it on a term sheet, for instance, along with the rating of the issuer. So the second most important risk, obviously this one is more obvious, is the market risk. Because a structured product's final value will always depend on the performance of one or more underlying assets. As an example, if a product is linked to the S&P 500, a negative performance on the index can have a negative impact on the product, if the product's embedded at, for instance, a buyer. Finally, here we highlight the complexity risk, which is important as well. The investor always needs to understand how the product could behave in different market scenarios. The behavior of a structured product is not always straightforward. It's up to salespeople usually to explain the risk to financial advisors and clients. And it's not about explaining the payoff, meaning what happened at maturity in different scenarios. It's also how a product could behave during its lifetime. Quick example, if a product is 100% capital guaranteed, according to the payoff, cannot expire below 100%. But during the lifetime of the product, for many reasons, rates can go up. And the products of the structured product, 100% capital guarantee, can go down and can worth below 100% during the life. So there is many risks to consider here. Hopefully, we have some tools to help assess those risks, and we'll see it on the next. And then on the next slide, we will see how the SRE can help us. So the SRE is the summary risk indicator. European regulator created the scale of risk from 1 to 7, rating products from less risky, which are 1, to the most risky, 7. The rating takes into account the volatility of the investment, so the market risk, and the credit worthiness of the issuer, so the credit risk. It's an information available on the KID, always the key information document that is given to you when you buy a structured product. So let's see a few examples here. We have better sense of the scale. Here, for instance, the first one, the less risky product ranked 1, is a 3-year 100% capital protected product with coupon linked to Esther and AA issuer. So the issuer is quite safe. It's a capital protected product. So the product itself is quite safe. It's one of the most safe products you can find in the industry. So it's ranked 1. The second one is pretty much the same, double A issuer, 100% capital guaranteed product. This one is just a little bit different because it's a bit longer. It's 5 years. So I guess that because of the maturity that goes up, the risk on the bond also goes up. So the longer the maturity, the bigger the risk of default. So it might be ranked 2 for this reason. The third one, so we move down, it's a little bit riskier. It's a different product. It's not 100% capital protected. Here we have a European buyer, meaning that if the underlying, which is Roche, goes down at maturity below the buyer, the investor may lose some money. So this is the main difference, which makes us going from 2 to 3 on the scale. The 4 is also a bit different, even riskier. We still have guaranteed coupon. Let me check. 70% European buyer, so the buyer is a bit less. Is a bit less risky. Double A issuer, so it's pretty much the same. Sometimes it's kind of hard to know exactly or to rank those products, but it globally makes sense when we look at the different level and we see them between them. Number 5 is a 2-year autocallable certificates on a worst of 3 volatile stocks. So this one we can understand very easily why it's ranked number 5 and it's higher risk than the other ones. For the first time here, we will not look at maturity at only one stock, but we will look at the worst performing stock among 3 volatile stocks. So it's a tool that is very common in the structured product industry. Not only look at one underlying, but several underlying, and only the worst of 1, of 2, 3, 4, or 5 underlying. So this is obviously more risky, hence risk number 5, and 6 and 7. So we fall into the category of leverage products, which are the more risky product you can find. And those products, for instance, for the number 6, it will give you the participation of the S&P 500 4 times on the upside, but also on the downside. So obviously, it's a very risky product. And for the last one, the 7, it's even riskier because it's a 10-time leverage. So you get 10 times the performance of Roche if it's up, but you lose 10 times if it's down. So far, we've seen how a structured product is built. We've seen the stakeholders, advantages and disadvantages of this product. And here we've seen how to assess the risk. Moving on to the next slide, we will know a little bit the theory and have a look at the different kind of products you can find in the industry.
So yeah, I will describe the first 2 kind of product that we'll speak about today. So the capital protection and the yield enhancements. Capital protection, the 4 type of product that are represented from the less risky one to the most risky one. So as Cyril went through the SRE indicator, you can see the less risky obviously is the capital protection, and then it goes to the yield enhancement one, participation one, and then leverage one. On the next slide, I will start speaking about the capital protection one, but Cyril has already started speaking about it a bit earlier. But typical kind of product is whenever you say capital protection, you typically need to have between 90 and 100% of your capital which is protected. And as Cyril said before, the capital is protected at maturity. So when we say that a product is 100% capital guaranteed, that means that you're 100% sure in case, obviously, there is no default from the issuer, so it doesn't take the credit risk into account. You're sure to receive 100% of your capital at maturity. The product may be worth less than 100%, obviously, during the life of the product. as we said, basically the bank is issuing a bond. So if interest rate increase just after the issuance, obviously the bond is going to decrease in value. So the product will lose some value, but at the end, you will get your money back if the issuer doesn't default. So the kind of product that you can have is the example given here. So the capital protection certificate, which is basically a bank issuing a zero coupon bond and buying some call. Typically, it's not that easy to build that kind of product, mainly because it's a bit too good to be true, I would say, because you have no downside and you only have upside. So how do we pay for that kind of structure? So first, obviously, you have a zero coupon bond. So if interest rates are high, obviously the zero coupon bond is worth less, and then you get a bit more margin to buy yourself some call. But still, getting exposure to a long call position is quite expensive. So the good thing is it's not a good thing, but that allows you to pay for that kind of stuff. So eventually you can do it on a stock which pays high dividends because the call option will be less expensive. You forego dividend. You're not going to receive the dividend of the underlying assets. And it's a structure that could be done when the market is not much volatile. So implied volatility is low. So the cost of your option is lower, and you might be able to buy some of this call option. As you can see on the next graphic, on the next slide, it's not always possible to buy yourself a full upside. So you can buy like a full call eventually because it's too expensive with the money you have left when you have issued a zero coupon bond. So sometimes what you do is you sell an upper strike call. So you create a call spread position. What does that mean? That means that basically you participate to the upside until a certain point that is called the cap. And afterwards, you don't participate to the growth of the underlying asset anymore. So if you buy that kind of product, you will be able to enjoy the growth until 50% upside, for example, in this case. But then afterwards, it's the underlying is doing, for example, plus 90% between inception to maturity. You will only have 50% of the performance. Otherwise, there is something else that you can do, and you can see it on the next slide. In here, as you can see, you don't have a full participation, so you have no cap. So in theory, you can grow until whatever. But in here, as you can see, if the underlying asset is performing by plus 50%, for example, you only get 30% of the performance. That means that you only have 60% of the upside of the underlying assets. So obviously, since you're only buying 60% of a call, it's less expensive. So that's typically the kind of capital protected product that you can do. But we can also speak about, so on the next slide, we can speak about the yield enhancement product. So yield enhancement product, as the name says, it's used to actually enhance the yield that you might have. So obviously, whenever you say yield enhancement, it's an enhancement with respect to what you would have had as a yield with the bond of the issuer. So the issuer in this case is typically a bank. So if a bank is issuing a bond, you might have like a 5% yield, for example. But well, with this kind of product, you might have something between 7 and 12, for example. So how does that work? I can give you a typical example. Eventually, if you have a bit time, but I don't think we will, we might give you a precise example. But a discount certificate, how does that work? Is basically you can buy the underlying asset, you can be long the underlying asset at a discount, so for cheaper price, but your upside is capped. So you know the maximum yield that you can have with the product, but then you still have the downside. It's just that if the underlying asset is going down, you will always be in a better position that if you had invested in the underlying assets because you bought it at a cheaper price. And if the underlying asset is not moving, well, you bought it at a cheaper price, so you get the maximum return. But then obviously, if the underlying asset is going up quite strongly, you won't benefit from this strong upside. So that's basically you're selling some upside. So you accept the fact that you might be not participating to the growth of the underlying assets, but for this, you receive a better yield. So in most of the case, you will earn a better yield. And in some case, you will have a lower yield should the underlying asset increase strongly. So you can see a graphic of this on the next slide. to be very honest, normally the cap is typically set a bit lower. It can typically even lower than the spot price. But that's easier to represent if you're not very familiar with this kind of product. So as you can see in here, again, you buy the asset cheaper. That's why even though the asset goes down, you can still earn money and have a positive yield. But if the assets perform quite strongly, don't participate to the strong upside, I would say. And again, don't forget that whenever you buy that kind of product, if the underlying asset is a stock, for example, you forego the dividends. So you don't benefit from the dividends. By not receiving the dividend, that allows you to create some other structure and benefit some other kind of performance as well, or protection. So yeah, I will let the flow to Cyril for the next kind of structured products.
Yeah, thank you. Okay, so then we have participation products. Those products do not pay coupon. Instead, they allow the investor to participate in the positive performance of the underlying. So let's look directly at the use case here. We have an investor that assumes a slightly rising underlying, let's say. He wants to profit to the potential upward performance of the underlying, and is willing to assume a certain downward risk, but still with a better protection than the direct investment. As a sales here, we could suggest a bonus certificate, for instance, because on the downside, the product will offer protection up to a certain buyer. And on the upside, the product will offer participation in the upward performance and even offer minimum profits if the underlying is not moving too much. Okay, so on the next slide, the graph will clarify a bit the payoff, so you can visualize it. So you can see that as long as the underlying never breach a certain buyer, which is here 10%, the investor makes a profit. Now, looking at this, you may think it's way better than having the underlying, obviously. So where is the catch? Well, there's two important disadvantages here of having the structured product compared to having the underlying. The first one is that, as we said, you bear the risk, the investor bear the risk of the issuer, the credit risk of the issuer. And the second one, which we need to think about as well, is that the investor here do not receive any dividend. It's the very biggest difference between having the underlying and having the structured product. So we need to keep this in mind. It's always the case for any structured product. The investor do not receive dividend. The dividend goes into the product and the strategy. Nothing is free. A better payoff always comes with a bit more risk. And talking about risk, let's move on to the next slide. We will talk about leverage products. Thank you. So it's the last type of products. They are more risky than the others as they use leverage. And as I said a few times now, if you want more reward, so leverage on the upside, you need more risk. So leverage as well on the downside. The best known product among leverage products are call warrants that we will see in the next slide after, and mini future that basically give 2, 5, or 10 times the exposure on the underlying that we saw on the SRE scale, for instance. So let's look at this final case. So here we have an investor that thinks that the underlying asset will rise. So as a sales, we could offer him a call warrant, which is similar to a vanilla option. So moving on to the next slide, we'll have a look at different scenario. Thank you. So here, whatever happens when you enter a strategy like this, the investor will lose the premium. So approximately here, it's 10%. It's the cost of buying the option. Okay. Then on the downside, if at maturity, the underlying trades below the strike price, it's 100% here, nothing happens. So the investor lost the initial investment. On the other side, on the upside, if at maturity, the underlying trade above the strike price, the investor gets the positive performance of the underlying. So as you can see, as the investor paid a certain premium to buy the option, he needs a certain performance. Here it's 10% to recover the initial investment before he makes a profit. And so we call it leverage product because buying the strategy 10% initially the investor could get back 50%, so 5 times the investment, if the underlying performance is 50%. So it's high leverage. And it could expire worthless quite easily as well if the underlying goes on the wrong direction or doesn't move at all.
Thank you very much, Cyril, Maxime. It's been a great session, and everyone attending too. We hope you enjoyed the session, and please don't forget to visit the Derivatives Academy website as well as SRP's Academy website, which will provide you with extra modules for expanding your knowledge about structured products. The slides that I showed at the beginning of the presentation will be available. So if anyone in the audience wants to get hold of them, please just drop us an email. And yeah, thanks again for joining the webinar. If you have any topics, by all means, just get in touch with Maxime and Cyril and myself, and we will try to address those in future webinars. And thank you very much for joining the webinar today, and see you next time.
Introduction to structured products. Structured products are investment vehicles made up of different building blocks. A bond or deposit that aims to provide the capital repayment feature and financial instruments linked to the underlying asset, which often is an option or derivative strategy that provides the return feature of the investment. The two components combined create a unique investment, and the level of risk and return can be customized to meet the needs of the target investor. Both the return and capital repayment depends on the performance of an underlying asset, such as equities, indices, funds, interest rates, currencies, commodities, and many other asset classes. Compared to other investments, structured products offer defined returns that are contractually binding, and the possible return and capital repayment scenarios are communicated to investors before the investment is made. Since most of the features are defined at the outset, they can easily be divided into different product categories, making it easier for investors to find investments right for them. They are bought by institutions, high net worth individuals, and retail clients. Let's start with capital protected products. When investors seek to get back what they invested at the end of a period of time, plus a return in excess of deposit rates, they use capital protected products. Their return is similar to bonds, and they are mainly used to provide participation in different asset classes whilst protecting the capital when the market drops. Now let's look at yield enhancement products. These products may provide investors the opportunity to generate higher yields and are suitable for investors willing to risk some or all of their investment to obtain this income. An investment in this category usually involves less risk than a direct investment in its underlying asset, since they often have some level of predefined protection against market falls. However, investors may potentially lose some or all of their investment if the underlying asset falls below this level of protection. Leverage products. Leverage products are used when investors are looking to take a directional position on an underlying asset while only investing a fraction of the underlying price. Investors therefore take advantage of leverage amplifying underlying movements. They are widely used to change the risk profile of investment portfolios, but are also used to hedge against negative market scenarios. What are the risks and benefits that you should be aware of before investing in a structured product? Benefits of structured products. Their flexibility means that they can give investors exposure to different asset classes, and they can be designed with different levels of protection, and the expected returns are clearly defined at the outset. Risks of structured products. Counterparty risk is the risk of a client losing money when there is a failure of the bank backing the product. Both returns and capital repayment may be exposed to downside market risk. You should be willing to hold your structured product to maturity, since there may not always be a liquid secondary market. This is not a complete list of risks, and you should always read the documentation of the product before investing and speak to your financial advisor before proceeding with an investment. Thanks for watching this video.